What's going on, you guys? It's Royce Jacob. Welcome back to the channel, and in this video I want to talk to you about why I believe the relief rally that we've seen in the stock market over the past couple months was a bubble, why that bubble just popped, and where I expect the general equity markets to head next. Alright, trust me, I know this is by no means an unpopular opinion. This is not an uncommon way of thinking. I just wanted to give you guys my take from both a fundamental and technical perspective in case you're at all interested. Okay, so over the course of this video, we will be looking at a chart of the SPX, S&P 500, good way to sum up the general equity markets, and we'll be taking a look at it on a bunch of different time frames, okay? So we will look at this relief rally, this bounce that we've seen over the past couple months, but I also want to show you guys 10 years back, 20 years back, even 30 years back, okay? I want to show you the macro big picture chart, all right? I feel like that's important, especially today and in this market when everything's so volatile, everything's so now. And trust me, I love the present. It's very important to think in present tense, but it's also good to look back at the historical data to know what's possible and to know how far you've come. Like, look at this. We will just look at this quick now. This is 2009, okay? So you can see this chart has gone up from $650 back in the financial crisis of 2009 up to over $3,000. Okay, so we've come a long way. A lot of people think this dip was completely catastrophic, which it was pretty bad. It was very sudden, but we're still way up, especially with where we're at now after this relief rally. We're so far beyond where we were over the past decades. Okay, and then we will zoom back, and I'll let you guys know what these lines are a little later in the video. Okay, but first I do want to focus on some of the fundamentals first, just to set the grounds for why I'm thinking the way I'm thinking. Again, I know a lot of you know, I have been talking about this on the channel a lot if you have been tuning in, that the economy and the stock market are very evidently, especially at this point, two very different things, okay? I understand that. I think everyone understands that by now, but that is the part that's scaring me, okay? That is almost the general consensus right now is, all right, the stock market and the economy are two very different things. And when a way of thinking and when a train of thought becomes general consensus, that, in my experience at least, is always a turning point, okay? So when everyone's thinking the same thing, that's usually when the tides start to turn, all right? And that's why I think that this little pullback that we saw this week in the markets is the first step to a larger move down, okay? And again, we'll cover the charts. We'll take a look at the charts in the end after I cover these articles. We're going to be looking at a few. Again, these cover the fundamentals. This one isn't loading. There we go. Record spike in new coronavirus cases. This one I didn't even read. 30% of Americans missed their housing payments in June. The rich have stopped spending, and that has tanked the economy. And then foolish to stand in the way. Fed support and the day trading boom will drive stocks higher, an analyst says. And this is what I'm talking about. This is exactly what I'm talking about when a way of thinking becomes general consensus. You know what? We'll start with this just because I'm already kind of ranting on this. But the Fed's decision to buy individual corporate bonds has put a massive floor on this market. Davey day trader Portnoy, love Dave Portnoy. I think I might make a video about him in the near future. Him and Warren Buffett and his retail bros are piling into stocks because they're confident the Fed will shore up prices, making it tough to be bearish right now. You have to find something that says it's going to be so powerful to bring the market down that even the Fed's unlimited printing and the Davey day trader crowd buying like mad is not going to help you stop it, he said. And I do agree with this to an extent, all right? If you have been watching recent videos on Robinhood and the retail investor movement, there's so much new money in this market that along with the Fed just printing money and injecting it into the economy and the markets is keeping it floating. That's my only argument for why it could go down or it could not go down. And trust me, that is a great argument. That is a very sound argument. And I will further explain more, not exactly. I'd never want to be absolute about anything I'm saying, but I will let you guys know again when we get to the charts what I think is likely to happen through my lens, okay, through my eyes. All right, but again, this is becoming general consensus. I've read articles about even some larger hedge funds piling in to the day trader day trading crowd and just all these new retail money. This stupid money, as it is called. Again, it's awesome that people are getting out there. There's people being exposed. There's younger individuals being exposed to the financial markets and learning and taking that first step to what could one day be financial freedom. I get it. I support that. But that makes for very volatile, very sketchy markets, which will play into my technical analysis a little later. Okay, so that's that. We'll call it there. That is just it. It just worries me when general consensus becomes, oh, the market is just going up forever. I guess we before, a few weeks ago, it was just a joke that stocks only went up. But now everyone's like, oh shit, maybe stocks do only go up. And when everyone starts thinking that, and everyone starts to pile in again, which I think has kind of just faded out, that is when the tides turn, and that is why I think the bubble just pops. All right, so we'll go over this. We'll go over these quickly. I'm sure I don't want to kind of bore you guys with these, but I'll try to summarize these as fast as I can. Just give you guys the idea of how shitty the economy actually is right now. Okay, so 30% of Americans miss their housing payments in June. As the United States continues to face record unemployment due to the coronavirus pandemic, 30% of Americans missed their housing payments in June, according to a survey by Apartment List, an online rental platform. That's up from 24% who missed their payment just 2 months earlier in April, and about on par with the 31% who missed payments in May. Additionally, the current 30 million unemployed Americans will lose the extra $600 per week in federal unemployment benefits at the end of July. So that's a big turning point. A lot of people, and especially these retail Joes, all right, this davey day trader gang, they're using that stimulus money. They're using their unemployment checks. It's free money, all right? It's just being handed to them. They didn't work for it. It doesn't have that same psychological, there's less of that psychological risk. There's less risk involved when you're playing with that money because you were just given to it, okay? It's monopoly money, and that is another factor that is propping up these markets right now is the fact that, the Fed is printing money, and the Fed is giving money to these large hedge funds who it is their job to deploy the capital within those markets. But the Fed is giving it to retail Joes too, okay? And again, it's great that they're gaining exposure into the financial markets. They're learning, they're day trading. But again, they're playing with monopoly money. This is all monopoly money at this point. That is scary. This money does not have just that same value that hard-earned money has, okay? And that scares me as well. So we will go on to this next one. Again, I kind of want to breeze through these guys just because I'm sure you guys are aware of a lot of this. Record spike in new coronavirus cases reported in 6 U.S. states as reopening accelerates. New coronavirus infections hit record highs in 6 U.S. states on Tuesday and marked a rising tide of cases for a second consecutive week as most states moved forward with reopening their economies. Arizona, Florida, Oklahoma, Oregon, and Texas all reported record increases in new cases on Tuesday after recording all-time highs last week as well. Nevada also, All right, so you guys get the point. Again, 6 U.S. states that were kind of on, they're leading the charge in the reopening, get the economy back up and running, is seeing a record number of new cases, and this is what I think will become the new normal. There's no way states are going to close back down. I don't think states will close back down personally. In America, we just have too much of that. It's almost foolish resilience, which, I mean, that's the American way. But I'm sure if you guys have caught it, Beijing is actually re-locking down. So Beijing has initiated a second lockdown because they're seeing such a significant spike in cases. And that is pretty telling of what could happen. Again, I personally, if I were a betting man, I wouldn't bet that we could close down again unless it got like absolutely catastrophic. But again, Beijing, China was about a month ahead of us, so you can almost look at them as a lagging indicator as to what might happen in the States, just because again they're like a month ahead. And Beijing, I'm sure you guys have all heard of Beijing, one of China's capital cities, has shut down again. Okay, so bad news. And again, this kind of my main point on this fundamentally is that I think a lot of people imagined, oh, once we're reopening, back in action, everything's back up, people are spending money again, everything's Gucci. All right, that's not the case. There's no way that is going to happen. Small, medium-sized businesses are still hurting. Again, a lot of the this is a very important piece. Like, Americans will lose this extra $600 per week in federal unemployment benefits. And then all the small, medium-sized businesses, like, the money isn't just going to keep flowing, okay? The money from the Fed and all the stimulus money isn't just going to keep flowing into the economy, at least as far as I know, unless we head to socialism, which, I mean, I don't support, but I wouldn't be surprised if, because we're kind of on track to do so. Unless that happens, unless small and medium-sized businesses just keep getting fed capital and fed money, they're going to be in a really hard spot, okay? Spending's down, consumer sentiment is down, people have been staying home. Like, habits have been formed to be less of consumers, all right? Consumerism as a whole is down after this pandemic and this lockdown because people have developed a habit to stop going out so much, stop spending. And again, as these states are reopening up, all these states that are reopening, bars are packed, everything's packed, and that's because everyone's been so suppressed for the past few months that they want to get out. So we will, which we are seeing now, we'll see an initial spike of consumerism, of perceived growth, and of the states, and just kind of the economy getting back to a sense of normalcy. Always put that in quotations. But I do think that after this initial shock of kind of a stimulated economy by people going out and just getting outside again, it will start to slow down. And again, I think people are just overestimating how even decent. I don't even want to say it'll be decent. I still think it's going to be bad once everything starts opening up. I think everything will not even be decent. I think it will be far underwhelming, and definitely not anywhere near where we were at the beginning of this year. Okay, so we'll move on to this. The rich have stopped spending, and that has tanked the economy. The wealthiest American households are keeping a tight grip on their purse strings, even as their lower income counterparts are spending a lot more freely when they emerge from weeks of lockdown. That decline in spending by the wealthy could limit the whole country's economic recovery. Researchers based at Harvard have been tracking spending patterns using credit card data. They found that people at the bottom of the income ladder are now spending nearly as much as they did before the coronavirus pandemic. For higher income individuals, that spending is still way far off from where it was prior to COVID, and it has not recovered as much. That's potentially crippling because the consumer spending is a huge driver of economic activity. In fact, so much of the country's economy depends on shopping by the top income bracket that the wealthiest 25% of Americans account for fully 2/3 of the total decline in spending since January. Okay, so the part that really stuck out to me in this article was that the wealthy are spending significantly less than the lower income bracket. Okay, so unfortunately, a lot of the people in the lower income bracket, I've looked at the Robinhood numbers, like the Robinhood app numbers, and a lot of individuals who download that app and are putting a lot of capital, new money, young money into that app, they have less than $30,000 a year. Okay, so that is definitely considered a lower income bracket, and that is the people who are investing in this market and keeping this market propped up. Okay, and I think this whole crisis as well is definitely highlighting the wealth gap and the problem with the wealth inequality in America. I'm not going to get into that. I could rant about that, but it is objectively an issue that the rich have stopped spending. It is a good way, just again, to gauge consumer sentiment. When the rich who have for the past decades been consumers, all right, like luxury goods. They have the picture of Louis Vuitton right here. Like luxury at the beginning of this year was hotter than it's ever been ever. That is now tapering off. Again, consumers are just consuming less. That's just a fact. Consumers are consuming less, and that just plays again into how shitty the economy is right now. And again, stock market, economy are very different things. The main point that I want to get across with this video is that this can't last forever. I don't think this can last forever. Again, it's becoming general consensus that the economy is just completely disassociated with the markets, and that stocks will probably just go up forever. All right, and that is a dangerous place to be. I think with this red candle, you see this weekly red candle we just saw, I do think that was a turning point. You know what? We'll look at this from the macro perspective first, and then we will zoom in on it just to the rally, because I have some lines drawn here that I want to show you guys. Okay, so we'll look at this from how about 2000, all right? Like, look how crazy that looks, okay? And the further you go back, the more extreme it gets, okay? So 2000, we had this bump up here. This collapse right here was the dot-com bubble that ended up bursting after that 2000 rally. Came back again. We spent a lot of time around this $1,400 region, and that is why I have this line drawn here, okay? This $1,400 region would also represent, $1,500 region. Call it 1,500 would represent just over a 30% pullback from highs, okay? And in history, we've seen that a few times. Again, right here, we're at $1,500, went to a low of about $750, $800, roughly 50%. 1,500 again, down to almost that exact same level at $750. Okay, so that was almost exactly 50% retracement. So we have seen 50% retracements in history. All right, and again, history is very different. Times are different. The dollar is worth less than it was back then. So you have to account for inflation in these, which does get a little complicated. But just to give you guys a general idea of my train of thought in this. Okay, so again, we saw a lot of time spent at the 1500 level in 2000, both 2000 and in 2008 prior to the financial crisis. Okay, dot-com bubble collapsed, financial crisis, market collapsed, and then since 2009, 2010, we have just been absolutely ripping. Okay, even when we had this extreme pullback back here, like the dip down was still higher than the market was in 2015. Just think about it rationally. Is the economy, and again, market and the economy aren't the same thing, but I'm making the argument that it will catch up at some point, and I think it will happen in the near future. Is the economy any better than it was in 2015? Obviously not. Obviously, the economy is way worse. Again, the markets and the economy are different, but I do think that because there is, like we're talking about with all these retail investors, all these retail traders in the market right now, I think that the weak hands obviously create more volatility. These are less experienced traders. These are people who are playing with monopoly money again, but it still hurts. It still hurts when you see your portfolio go down. I remember being a younger trader. When you see those significant red days, you get scared, you panic sell, and I think that is what a lot of this retail-driven Robinhood market is going to bring, is a lot of panic selling, a lot of panic buying. I have talked about volatility in the past. I'll make a video talking about volatility in the near future, but it's just going to lead to a lot, there's a lot of weak hands in the market. All right, a lot of inexperienced traders equal weak hands, and weak hands equal sell on a really bad day. And I think that will be the catalyst once people start selling, and all these kids who are trading on margin for the first time, because I guarantee a lot of them are trading on margin. Once they get margin called out and are actually forced to sell, even if they don't have weak hands, even if they have developed some strong hands and they can stomach it, they will get margin called out of their positions and they will have to sell, okay? And I think when that happens, which I think will happen soon, to be completely honest, I think that the floodgates are open and that we will see another corrective move down. This would make sense if things get really dirty and the market gets super bloody. Again, a 50% retracement from highs. It's a little more, so maybe it might be more in this region. But I think definitely we will see a retest of this area that we spent a lot of time around in 2015 and 2016. Okay, so I think the SPY could pull back a solid 30%, roughly, or S&P 500 could pull back a solid, like 30% from 3,000 where it's at right now, down to $2,100. That wouldn't surprise me at all. It's just below those previous lows. But then once that happens, once we see that second wave of pullback, and you guys know that if you have watched, I always say you guys know, but if you guys have watched the channel before and watched my videos, you guys would know that I think everything, when it comes to super highly volatile and super bubbly things, you'll always see two waves. Okay, so we saw this huge initial pullback, all right? And then the relief rally. But then a lot of times you see things happen in waves of twos, okay? And that's why I think the second wave is coming. As a betting man, I do have money on this. I'm shorting the SPX and the SPY. I do think it will probably hit the $2,100 region, if I'm being honest. Again, I don't want to make any near-term predictions. I think things happen fast, again, because there is so much volatility and just so much uncertainty, weak hands, everything I just covered in the markets right now. I do think that this could happen almost equally as fast. Probably not as fast as this, because this was pure shock and a liquidity crisis. But I think it could happen like something that might look like this right here back in 2018. Okay, so that is over the coming months. I think the end of summer. Summer is traditionally like rough months for the SPY and general equity markets. So I think this summer will be rough. Elections are coming up this year. There's so much civil unrest, global uncertainty. India, China are just starting to go at it. North Korea and South Korea are going at it. Everything we just talked about here. The world is chaotic right now. The markets are acting like it's not. And I have to think that it will catch up at some time. All right. So I went super long on this one, you guys. Sorry. I'm really passionate on this specific subject and on just kind of how crazy the markets are right now. So please let me know if I missed anything. Drop a comment down below if you want to talk about anything that I covered in this video. I definitely did a rant. I apologize for that. I'll try to sum it up a little more in future videos. But yeah, just let me know what you think about this. Always appreciate feedback from you guys. Always appreciate learning from you guys, and just appreciate having you guys around and creating this solid community on this channel. Okay, so we will call it there, guys. One more thing, again, like the video if you haven't already. If you did gain any value, subscribe to the channel if you are new around here, and please check out the complete portfolio down below if you want to know exactly what put options I have on SPY and literally every other position in my entire portfolio. Exactly as it states, it's a complete breakdown of every call option, put option, stock position, cryptocurrency I have in my portfolio. Along with that, I send out a newsletter every trading day talking about which trades I made that day, why I made the trades I did, and just more real-time feedback from me and insight from me on my thoughts on the markets overall. All right, so check that out. First link down in the description if you are interested. If not, no worries at all. We'll call it there, guys. Until next time, always remember, take action, make waves. Peace.